Hello and welcome. Welcome to your daily dose of financial science with Dan. Today we're going to look at how to account for your sales. It's a very interesting topic that we're going to look at. Sales is recognized or accounted for when it is earned and not when cash is received. Sales is considered as earned when the service or the product is considered delivered to the customer. Follow me closely. Sales is recognized when it's earned and not when cash is received. And sales is considered as earned when the service or the product is considered delivered to the customer, or when ownership or control per the contractual agreement lifts the hands of the seller to the hands of the buyer. Revenue recognition is based on the accrual basis of accounting and not cash basis. What is cash basis? Cash basis is which is very typical among most small and micro businesses, maybe not too much with medium scale businesses. Sales are only recognized when they have received cash. That is a wrong approach. That is not how the standard prescribes for you to recognize your sales. It says that sales is earned when the transaction is delivered and not only when cash is received. Now, the accrual basis of accounting gives rise to number one, payments in advance, which is also called deferred revenue or prepayment. What does it mean? It is not rocket science. Follow me closely. It's not difficult to understand. Now, for example, use and sell cleaning agents. So in August, you get an order. So someone makes an order in August and you deliver the cleaning agents to a school. So delivery, and then they paid you later in the year. They paid you in December. They paid you in December. So payment is in December. Per the explanation and per the standard practice, you're supposed to recognize sales in September because that's when you delivered the transaction and not when you got the money. This one gives rise to you delivered before you got paid. So it means that they owed you. Okay, so it accrued revenue delivered before they paid you. So it accrues revenue. So which creates a current asset. They owe you. They owe you. It's a receivable. You're going to receive it. It creates a current asset. Okay. This is scenario number one, case one. Let's look at another case. Same period, same thing. Okay. This time around, the order comes. Okay. And then they pay you in advance. And then you're supposed to deliver in December. Remember that you only recognize sale when it is earned, and the end is when you have delivered. So you're going to recognize your sale in December, but that gives rise to payments in advance, so prepayments. You were paid in advance. And the fact that you are paid in advance, follow me, dear business person. If someone makes an order and the person pays you advance, what it means is that you owe the person. Okay, so that is a current liability. That's case number two. Case number two. Let's get back to our notes and then follow from there. Saying is that the transaction, the sale transaction, creates these scenarios, and therefore you must know how to recognize it. And you don't recognize it only when cash is paid. Because if you have received cash and you have not advanced the product and it is still in your store, how do you account for it? But when you follow the principle as being stipulated by the standard, you'll be able to account for it properly. Now, what is the dose that you need to pick for today? Not all cash received from a sale or service agreement constitutes sales. Sales must only be recognized when the product is delivered or the service is rendered. Payment in advance means you owe the buyer, so your priority in expending the advance payment must be to deliver the contract. Do not spend the advance payment on anything else but the purpose for which it was advanced. Thank you very much for sticking and staying with us for today. Catch you on the next one.